So, how do you actually value a $26 billion Permian giant? If you've ever looked at a massive, highly complex oil and gas operation and wondered how Wall Street assigns a literal price tag to all that dirt, steel, and crude, well, you are in exactly the right place. Welcome to The Explainer. Today, we're putting on our professional sell-side equity analyst hats. We aren't just going to look at stock charts, okay? We're going to build a rigorous, fundamental valuation of Diamondback Energy entirely from the bottom up. Let's just dive right into this. To get to a true intrinsic value for Diamondback Energy, ticker symbol FANG, by the way, we're going to rely strictly on the company's latest filings. We're talking their Q1 2026 earnings release, their 2026 proxy statement, and supplementary analyst reports, quoting specific notes and pages as we go. Our goal here is to translate these incredibly dense financial documents into a clear, step-by-step discounted cash flow model. Here is our roadmap for today. We'll cover 1. Core business and position. 2. Geography and risks. 3. Deriving free cash flow. 4. Calculating cost of capital. 5. Forecasting growth. And 6. The DCF valuation itself. All right, starting off with Section 1, Core business and position. Before we can even think about projecting future cash flows, we have to understand what the company actually sells and what their competitive position looks like right now. Pulling straight from page 4 of their Q1 2026 condensed consolidated statements of operations, we see they brought in a massive $4.24 billion in total revenue for the quarter. And the vast majority of this, about $3.825 billion, comes directly from the sale of oil, natural gas, and natural gas liquids extracted from their own acreage. They also brought in $385 million from the sale of purchased oil. So, right off the bat, this shows us a highly concentrated revenue stream that is directly tied to commodity extraction. Now flip over to page 7 to their Q1 operations update, and you can really see the sheer physical scale of Diamondback's operations. Just look at the Midland Basin total alone. 118 gross wells drilled and 147 gross wells completed in a single 3-month period. They are aggressively tapping into zones like the Lower Spraberry and Wolfcamp A and B. This level of constant completion activity, that's the operational heartbeat required to support management's baseline production target of 520,000 barrels of oil per day. To fully grasp their operational flexibility, though, we need to bust some industry jargon really quick. Have you ever heard the term DUCs? It stands for drilled but uncompleted wells. These are essentially Diamondback's operational levers. When management talks about, say, adding a completion crew in response to global supply disruptions, they are talking about converting these DUCs into producing assets. It's a huge advantage because it allows them to rapidly ramp up output without having to start the whole drilling process from absolute scratch. Moving right along to Section 2, Geography, Life Cycle, and Risks. So we know they can pump a ton of oil, but what's the catch? What threatens that cash machine? Well, in any rigorous valuation, we have to weigh the competitive position against the material risks. And frankly, Diamondback's greatest strength is also its absolute biggest vulnerability: geographic concentration. S&P Global actually called this out specifically in their BBB rating upgrade. Being purely a Permian Basin operator exposes them to some severe localized bottlenecks. Take the Waha Hub, for example. It's a regional natural gas price hub out in West Texas that is infamous for wild pricing volatility because of pipeline constraints. Management actively has to manage risk around Waha gas pricing because local blowouts there can severely impact realized revenues. And as analysts, we absolutely have to price these specific material risks into our required rate of return. Beyond just the everyday commodity volatility and their Permian concentration, the 10K risk factors highlight a very real regulatory risk. Specifically, the Texas Railroad Commission recently placed a moratorium on new produced water disposal well permits to control seismic activity. That's a huge deal for day-to-day operations. Add in the execution risk of integrating their massive $26 billion merger with Endeavor Energy Resources, and you can see exactly why we need to be somewhat conservative with our valuation multiples. Which brings us to the fun part, Section 3, Deriving Free Cash Flow. This is the financial engine of our whole analysis. We are going to build our discounted cash flow model by literally extracting the cash from the dirt, bridging reported accounting figures all the way down to unlevered free cash flow. But listen, as fundamental analysts, we must draw a very strict line between the hard data we pull and the external assumptions we're forced to make. From the Q1 26 guidance, we have some hard numbers: $933 million in cash capex for the quarter, a guided corporate tax rate of 23%, and a 5.55% interest rate on their newly issued 2035 senior notes. However, filings don't hand you everything, so we must explicitly state our assumptions. We are utilizing a standard 5% market risk premium, pegging the risk-free rate to the 10-year Treasury, and we're deriving our beta externally from a basket of publicly traded exploration and production peers. So let's walk through the actual math in motion. This table here is our derivation bridge down to unlevered free cash flow, or FCFF. We start at the top with operating profit, or EBIT. We subtract out those taxes using that 23% rate we just talked about. Then we add back our non-cash charges. And for a company like this, that's a massive $1.293 billion in depreciation, depletion, and amortization reported in Q1. Next, we subtract the $933 million in cash CapEx and adjust for changes in net working capital. The result at the bottom? That is the actual unencumbered cash available to all investors, both debt and equity. Just to put it in perspective, in Q1 2026, the reported operating cash flow before working capital changes was over $2.6 billion. That shows you just how insanely cash generative this business model really is. All right, moving to section 4, calculating cost of capital. We've got our cash flows, but how much do we discount them by? We need to establish our hurdle rate, the weighted average cost of capital, or WACC. And constructing the WACC is basically a 3-step process. First, we use the capital asset pricing model for our cost of equity, relying on that declared 5% equity risk premium assumption. Second, for the cost of debt, we actually don't have to guess at all. The 2026 proxy explicitly highlights their recent offering of $1.2 billion in senior notes at a 5.550% interest rate. Boom, that's our pre-tax cost of debt. Finally, we just weight those two costs based on Diamondback's target capital structure, utilizing the actual assets and liabilities right off their latest consolidated balance sheet. Next up, Section 5, Forecasting Growth and Margins. Okay, let's look into the future for a second. With our baseline production set by management at 520,000 barrels of oil per day, we have to forecast just how efficiently they can maintain and grow that output over our explicit 5 to 10-year forecast period. According to a DBS Bank analyst report on page 12, Diamondback's EBITDA margins have actually compressed slightly, dropping from an incredibly high 76.1% in 2023 down to 67.6% in 2025. This margin compression in a mature shale environment highlights exactly why the company is relentlessly pursuing efficiency gains. Things like simul-frac operations, where they fracture multiple wells simultaneously just to save time and service costs, are absolutely crucial moving forward. Now, as we push our model past that initial explicit forecast period, we have to determine a terminal value. And because SEC filings don't just hand you a convenient 30-year terminal growth rate, we must declare an explicit external assumption here. We are assuming a 2.5% terminal growth rate. We justify this because it perfectly aligns with the long-term U.S. GDP growth rate, essentially representing a mature, steady state where the company grows in lockstep with the broader domestic economy. Finally, the moment of truth. Section 6, Discounted Cash Flow Valuation. Let's bring this whole thing together. We are taking all our operational data, that 23% tax rate, our calculated WACC, and our 2.5% growth assumptions into one ultimate intrinsic value calculation. Here's the final architecture. We sum up the present value of our explicit 5-year free cash flows, and we add the present value of our terminal period. That gives us our enterprise value, the value of the entire firm. But as equity analysts, we only care about the shareholders today. So we subtract out the net debt, which management defines as total debt less cash and cash equivalents. That yields our equity value. Finally, we simply divide that by the roughly 289 million diluted shares outstanding to get our price per share. Drumroll, please. The result of our rigorous, fundamental, bottom-up model, an intrinsic value of roughly $222.70 per share. And what is genuinely fascinating here is that this mathematically derived figure remarkably mirrors the consensus estimates from outside platforms. Simply Wall Street pegs their fair value right at $222.70 as well. And Wall Street Zen has an average target of around $226. Considering the current share price has been hovering in the 188 to 195 range, our model indicates a really solid implied undervaluation. And that's largely driven by their massive free cash flow generation and the fact they returned $3.2 billion to stockholders in 2025 alone. But hey, looking at the spreadsheet only tells half the story, right? Diamondback's management explicitly warned in their filings that as the U.S. shale industry matures, they are having to spend way more capital testing deeper, secondary zones like the Barnett and Woodford shales, simply because the obvious premium Tier 1 targets are disappearing. So I leave you with this final thought.
With the best Permian acreage increasingly gobbled up by mega mergers like Diamondback's own $26 billion Endeavor deal, what happens to valuations when the U.S. shale industry finally runs out of premium dirt to buy? Who will be the next target in the great U.S. shale consolidation? Thanks for joining me on this explainer, and keep analyzing.